Hi everybody! In today's video we are going to investigate the world of the ETF, Exchange Traded Fund, and lay out the checklist to invest in those instruments in 2024. Moreover, stay with me till the end of this video, as I'm also going to share with you a promo code that will allow to have a discount in the Just ETF platform for a one-year subscription. The Just ETF team was so kind to allow the first 100 subscribers to the Stoic Investor channel to obtain a discount to their platform till end of 2024. Therefore, without further ado, let's start this video. Mutual funds are investment products that pull together money coming from different investors. The fund manager actively manages the money by deciding in which security and asset to invest the fund. However, you can't actively buy and sell in general. You can't actively trade the single pieces of the fund because they are composed of a basket of assets and therefore cannot be split. On the contrary, an ETF, an exchange traded fund, is an investment product that aims at tracking the performance of an index, like for instance the Hang Seng or the Standard & Poor's 500. However, contrary to a mutual fund, it can be traded like a normal stock, meaning that the investor can decide at any time to buy and sell single pieces of this product. ETFs are said to combine the best of the two worlds, stock and index. In fact, contrary to normal stock, they offer much more diversification because they are a combination of a basket of either stock or bonds. However, contrary to a fund manager that gets paid in order to attempt to beat an index, ETF passively track the performance of an index. Therefore, they are cheaper compared to a normal fund. Also, with respect to this reason, they offer a much more predictable set of possible returns, since their aim is just to track an index. And finally, as I said before, they can be normally traded during every day, meaning that the investor can buy and sell single pieces of an ETF. As with every financial product, there are pros and cons. I will therefore list 4 for each one of them. Starting with the pro, I would say first of all they are much cheaper compared to normal funds. Then also they allow for having a lot of transparency, meaning that the investor at every point in time knows exactly in what type of market he or she is investing into. Also they allow a lot of diversification, meaning that you would rather see an ETF that is highly concentrated in one single asset. And finally, they allow the investor to access even the most remote and exotic type of market. In terms of cons, first of all, I would say you are exposing yourself to the capital risk, because the principal of your investment is not guaranteed at all, as in every type of equity investment. Then I would say you are exposing yourself to the tax risk, meaning that you're going to receive international taxation depending on the type of ETF you are selecting. Then there is also the currency risk, because different ETF might be issued in different set of currencies. And finally, you have the liquidity risk. As we will see in a while, ETF might have a different size and different set of liquidity in terms also of market depth. And we have now reached the point of the investment process, and I'm going to share with you my personal checklist that I would suggest that you use every time you want to invest in an ETF. It starts with the investment focus, where first of all you need to determine the percentage of your portfolio that you would like to invest with an ETF. With that, you need to decide the asset class of the ETF. Equity, bonds, currency, commodities, you name them. Once you have decided that, you need to determine the country, region, and geographical area in which you want to invest, and also the specific sector, in case, for instance, you opt for an equity index. Once you manage to go through all attributes of point number 1, namely that you manage to restrict the possible universe of your investment, you need to select all indices that would allow you to get exposure to those type of investments. In order to compare the performance of those indices, I would suggest that you go through two main attributes: the currency and the distribution type. If for the currency, it is quite obvious that you should only compare the performance of ETFs that are expressed in the same currency. For the distribution type, it might not be so straightforward. In fact, you need to know that ETFs are split between distributing and accumulating type of ETF. In the distributing type of ETF, every payment made by the underlying index, dividend or interest in general, are paid out to the investors in the ETF. On the contrary, in the accumulating type of ETF, every payment made by the underlying index, dividend or interest, are accumulated into the performance of the ETF itself. There are two main types of ETF structures. There are physical ETF, where the underlying exposure is achieved by physically buying and selling the underlying index, and there are synthetic ETF, where the exposure is achieved not by buying and selling the underlying asset, but is rather replicated via the use of derivative product. There are two main types of cost when investing in ETF: transaction fees and fund expense ratio. Transaction fees are incurred every time you buy and sell the ETF, as every financial product, whereas the expense ratio is computed annually and basically summarizes all costs you are exposing your portfolio when investing in ETF. In order to assess the liquidity of an ETF, there are three main ways. The size of the ETF, which basically summarizes the total volume that is traded on that specific fund. Then we have the liquidity of the underlying asset, being it a bond or an index. And finally, we have the bid-ask spread. The bid-ask spread is a measure of the difference between the best price at which you can buy and sell the ETF. So, for instance, if the best price at which you can buy an ETF is 25.25 and the best price at which you can sell the ETF is 25, then the bid-ask spread is 0.25, which I would say is quite a good measure of the liquidity of this fund. So, in a nutshell, the smaller the bid-ask spread, the higher the liquidity in the underlying instrument. So let's say you come to me with a question. You save some money that you want to invest with an ETF in 2024. So let's go through our checklist and see what we can do with that. So let's say you want to invest in the equity market in the US and you would like to allocate 10% of your portfolio. You don't want to have any type of particular sectoral exposure and just focus on the general US economy. Given the focus of your investment, there are several indices available to you. There is the Standard & Poor's 500, the Nasdaq, the Dow Jones, the Russell 1000, 2000 and 3000. Your preference, however, goes to the Standard & Poor's 500. For today's video, the team of Just ETF was so kind to allow the first 100 subscribers to the Stoic Investor channel to enjoy this perk till end of 2024 by using this discount code. To go through the other steps of the checklist, I will use one of my favorite free ETF platforms, Just ETF, but you can browse for them as there are many available to you. I will use my personal account to go through the example. From the comparison, you can see that the ETF performance are all broadly aligned. It is important, however, to look also at the past performance to eventually confirm our thesis and check also when the ETF had been launched. In doing that, I always like to check the return-risk ratio, which measures the return generated per unit of risk taken. Moreover, we can also see that two ETF, namely the iShare and Amundi, are accumulating type of ETF, whereas the Vanguard is a distributing type of ETF. By comparing the ETF structure, we can see that the Amundi ETF uses derivative to replicate the performance of the index, whereas all other ETF adopt a full replication mode, which means that they are basically buying the underlying stocks. Since I personally don't like to have derivative replicating the index performance, as this can expose my portfolio to additional risk, I would like to drop this ETF from my list. When looking at the cost, we will refer to the total expense ratio, which measures the total cost for an investor in that particular type of ETF. The two expense ratios are very contained and aligned, with no major differences between the two ETFs. Let's finally assess the liquidity of the two remaining ETFs by starting from the fund size. There is actually no competition in this category, with the iShare ETF that reaches almost 75 billion, twice as much as the Vanguard one. To conclude, I personally would suggest to select the iShare ETF because of the very contained total expense ratio, the high return risk metric, and the fund size. And this leads us to the end also for today's video. I hope you enjoy it and in particular you appreciate the discount code offered by the Just ETF team. Before leaving you, please don't forget to give a thumbs up, subscribe to the channel and pin the notification bell. That's all for today, cheers and see you next time.